Now, if you've got money in the bank, you're probably fed up with how little interest the banks pay nowadays. To make their money work harder, some savers have loaned their cash directly to companies that want it. According to Shares magazine, companies like Tesco and the National Grid have raised £3 billion directly from savers in the last 3 years by selling them retail bonds. And the latest big name to launch one is the Jockey Club. It unveiled its retail bond this week. But is this race for better returns just too big a gamble? Darius BBC is an independent financial advisor, managing director of Chelsea Financial Services. Welcome to Your Money.
Hello.
And at face value, these things look a lot more tempting than what the bank is offering. There's the Jockey Club this week, 7.75% interest a year.
Yeah, I mean, the rates are much better than you can get in cash at the moment, but you do also need to bear in mind that they're not protected. When you put money in the building society or the bank, your savings are guaranteed, but these rates are not guaranteed, nor is the capital that you may get back guaranteed.
So you are relying on the company being able to pay back the cash that you've loaned to them plus the interest on it.
Indeed, it's the ability of the company to pay you that cash rate, the agreed rate on the bond, and then to give you your money back at the end are the key things. And it is not protected by the Financial Services Compensation Scheme. So just to beware for people thinking about that type of investment.
So if they can't pay it back?
If they can't pay it back, your capital would be fully at risk.
That's it, you're snookered.
Your money could be gone.
So what sort of research do you need to do into these companies before handing over your hard-earned money?
Yeah, I mean, it's quite difficult. I think the general investor in the street would struggle to look at the sort of metrics that you'd need to, things like cash flow, balance sheet, to be able to work out if it is the right investment for you. I would suggest that most investors should be looking at a bond fund where you employ a fund manager to look at the various different types of bonds, and they do have the skills and the resource to do that. And you, of course, get extra diversification of not just investing in one bond, but a number of securities. And that's probably a more sensible route for people looking for the next stage up from cash.
And of course, it's right that we talk about the risks, that we highlight the risks, because they are there and they are live risks. But £3 billion raised over 3 years means these retail bonds are tickling the fancy of some investors.
Well, with cash rates being so low, I mean, 0.5% is the base rate. You can barely get 3% on a savings account at the moment. These are offering better rates and they are being attractive from a rate point of view. So,
okay,
yes.
Darius BBC, thank you very much, Managing Director of Chelsea.